4 days. That's how long American investors have to decide what to do with their Chinese stocks before the ban kicks in. Not a suggestion, not a proposal. An actual federal prohibition that makes it illegal for U.S. citizens to hold shares in dozens of Chinese companies. And while retail traders are panic selling and Reddit threads are melting down, JP Morgan just did something very strange. They went long, aggressively long, on Chinese equities. Now, either the largest bank in America knows something the rest of us don't, or they're about to make a very expensive mistake in front of the entire world. Because here's the thing about countdown clocks in finance. They don't usually stop. This isn't some random trade war tantrum. This is the execution phase of something that's been brewing since 2020. The law is called the Holding Foreign Companies Accountable Act. Terrible name, very effective law. The basic premise was simple. If you're a Chinese company and you want to be listed on American exchanges, you need to let American auditors actually look at your books. Not summaries, not edited versions, the real numbers. China said no. Not because they're hiding anything necessarily, but because allowing foreign auditors into Chinese companies would, in their view, compromise national security. Fair enough. Sovereign nations get to make sovereign choices, but so does the United States. And the U.S. choice was this. If we can't verify your accounting, you can't access our capital markets. 3 years to comply. No compliance means delisting. The deadline passed. The warnings were issued. And now we're here. 4 days until the ban goes live. Over 60 Chinese companies are on the chopping block. Some you've heard of. Alibaba, Baidu, JD, Comp. Others are smaller but still manage billions in market cap. When the ban hits, U.S. investors will be prohibited from holding these shares. Not discouraged, prohibited. As in, your brokerage will force liquidate your positions if you don't sell them first. Which is why the smart money was supposed to be running for the exits weeks ago. Except JP Morgan didn't run. Here's what JP Morgan did instead. In the last 2 weeks, they increased their positions in Chinese ADRs by 11%. That's not a hedge. That's not a token gesture to maintain exposure. That's a bet. They added to Alibaba. They doubled down on Tencent's holding structures. They bought into Chinese EV makers that most American analysts stopped covering months ago. And they did this quietly. No press releases. No analyst notes hyping the trade. Just slow, deliberate buying while everyone else was heading the other direction. Now you might think, well, maybe JP Morgan has a loophole. Maybe the ban doesn't apply to them. It does. The ban applies to all U.S. persons and entities. Institutional money doesn't get a pass. If anything, they're more visible, more regulated, more exposed to enforcement risk. So why would they do this? There are 3 theories. One boring, one cynical, one actually kind of brilliant. The boring theory is that JP Morgan thinks the ban will be delayed or watered down. Maybe there's a last-minute carve-out coming. Maybe the new administration walks it back. Possible. But betting billions on a policy reversal 4 days before execution is not typically how institutional risk management works. The cynical theory is that JP Morgan knows they'll be forced to sell, but they're front-running a bounce. Chinese stocks have been beaten down so badly that even a temporary rally could generate returns. Buy low, let the liquidation deadline create short-term chaos, sell into the volatility, get out clean. Also possible, but risky. Because if everyone tries that same trade, there's no one left to sell to. Which brings us to the third theory. JP Morgan isn't planning to sell at all. Here's where it gets technical, but stay with me because this is the whole game. The ban doesn't prohibit Americans from owning Chinese assets. It prohibits them from owning Chinese securities listed on U.S. exchanges that don't comply with auditing requirements. That's a very specific box. And if you're a bank with enough resources and legal creativity, you don't have to stay inside that box. What JP Morgan appears to be doing, and other institutions are watching very closely, is restructuring their exposure through offshore vehicles. Instead of holding shares directly, they hold them through subsidiaries registered in Hong Kong, the Caymans, Luxembourg, places where the ban doesn't apply because the entities technically aren't U.S. persons. Is that legal? Depends who you ask. The Treasury Department has made it clear that shell games won't work. If a U.S. entity controls the offshore vehicle, the ban still applies. But control is a fuzzy word in international finance. Ownership gets layered, decision-making gets delegated, and suddenly it's not clear where the line is. JP Morgan has an army of lawyers. They've done this kind of restructuring before in Russia, in Iran, in every other market where sanctions created complications. And if they pull it off, they'll be holding Chinese exposure while their competitors are locked out. Which means when the dust settles and Chinese markets recover, JP Morgan gets the upside alone. But that's only if the restructuring holds up under regulatory scrutiny, which it might not. Let's talk about what's actually at stake here. The total market cap of Chinese companies listed on U.S. exchanges is around $1.2 trillion. Not all of that is affected by the ban, but a significant chunk is. When you force liquidation on that scale, prices don't just drop, they collapse. Because everyone knows the sellers don't have a choice. They have to sell. Which means buyers can wait, they can lowball, they can pick up assets at a massive discount. JP Morgan seems to be positioning itself as one of those buyers. But here's the uncomfortable part. If Chinese stocks do crater because of forced selling and JP Morgan scoops them up through offshore structures, who actually wins? Not retail investors. They're the ones being forced out, not Chinese companies. Their valuations are getting hammered. The winners are the institutions big enough to navigate the loopholes and patient enough to sit through the chaos, which is fine. That's how markets work. Big players have advantages, but it does raise a question about what the ban was supposed to accomplish in the first place. The stated goal was accountability, transparency, making sure American investors aren't funding companies with opaque financials. But if the end result is just wealth transfer from retail to institutions, while Chinese companies continue operating with the same accounting practices as before, what exactly did we achieve? JP Morgan isn't breaking the rules. They're just playing a different game than the one regulators thought they were setting up. And here's the twist. China might actually be fine with this. Think about it. For years, Beijing has been trying to reduce its dependence on U.S. capital markets. They want Chinese companies listing in Shanghai and Shenzhen, not New York. They want yuan-denominated financing, not dollar financing. But companies kept going to the U.S. because that's where the liquidity was, where the valuations were higher, where the prestige lived. This ban forces Chinese companies to rethink that strategy. It pushes them toward domestic exchanges, whether they wanted to go or not. And in the long run, that might strengthen China's financial infrastructure more than it hurts their companies. Meanwhile, the U.S. loses visibility into a massive chunk of the global economy. We lose the leverage that comes from having Chinese firms dependent on American investors. We lose the information flow. So who got punished here? The narrative says we're holding China accountable, but the actual mechanics suggest we might be holding ourselves accountable instead. And JP Morgan, reading the same script everyone else is reading, decided the smart move was to lean in rather than pull out, because they know something that's easy to forget in all the noise. Markets don't care about fairness, they care about math. And the math says that when assets get sold at distressed prices because of regulatory pressure, someone on the other side gets very rich. This isn't just about one bank making a contrarian bet. This is a preview of how financial decoupling actually works. For years, people talked about the US and China separating economically. Two systems, two spheres, clean break. But the reality is messier, because money doesn't care about borders the way governments do. Capital finds gaps. It finds gray areas. It finds jurisdictions where the rules don't quite reach. And institutions like JP Morgan are very, very good at finding those gaps. The ban was supposed to simplify things. Chinese companies either comply with US rules or they're out. Binary choice. But what's actually happening is complexity, layered structures, offshore vehicles, competing interpretations of what counts as ownership. And the more complex it gets, the more advantage flows to whoever can afford the best lawyers and the most sophisticated compliance infrastructure, which is not most people. Retail investors don't have Cayman subsidiaries. They don't have teams of lawyers parsing the definition of control. They just get a notice from their broker saying their positions will be liquidated in 4 days. Meanwhile, JP Morgan is restructuring, repositioning, and preparing to be one of the few players left standing when Chinese markets stabilize. Is that unfair? Maybe. But it's also predictable. Every time regulators try to draw a hard line in global finance, the line bends. Not because anyone's breaking the law, but because the law exists in one jurisdiction and money exists everywhere. And the institutions that understand that gap own the game. So here's where we are. 4 days until the ban takes effect. JP Morgan is long. Most other institutions are neutral or short. Retail is panicking. And nobody really knows what happens next. If the ban holds and enforcement is strict, JP Morgan either found a legitimate loophole or they're about to get burned in a very public way. If the ban gets delayed or softened, they look smart for holding through the fear. If Chinese markets collapse and don't recover, they lose billions. But here's the thing about JP Morgan. They didn't get to be the largest bank in America by making reckless bets. They have information, they have models, they have access to policymakers and regulators that most of us don't. Which means their move isn't random, it's calculated. And that calculation is based on a view of the future that we can only guess at. Maybe they think the ban is theater, a political gesture that won't survive contact with economic reality. Maybe they think Chinese markets are so oversold that even a bad outcome is priced in. Or maybe they just think that in a world where US and Chinese finance are splitting apart, the real money is made by being one of the few bridges left standing. Because when two systems separate, the connectors get very valuable. 4 days. That's how long until we find out if JP Morgan is right, if their legal structures hold, if their thesis plays out, if the gap between rules and reality is wide enough for them to slip through. And if they're wrong, we'll hear about it. Banks don't hide losses at this scale, but if they're right, you probably won't hear much at all. Just a quiet reconfiguration of who owns what. A subtle shift in where Chinese capital flows. A small reminder that in global finance, the players with the most resources don't fight the rules. They just hire better lawyers. And sometimes that's the same thing as being right.